time for viewer mail.
We have viewer mail?
We do.
Good. If you'd like to send your questions in, I'd be happy to answer them. Send them to doug@riskandrewardtv.org. What do we have this week?
This is from Pat in Black Diamond, Washington.
Thank you, Pat.
And Pat asks, how do I short a stock?
Good question. A lot of people don't normally short stocks, so let me cover it really quickly. You can be bullish, which is going long or buying stock, or you can go bearish, which is going short or selling stock. And you can be on either side of the transactions. Now, you can't short stocks in a retirement account, so if you're thinking your IRA, your 401k, you can't do that. But here's the way a standard stock transaction goes on, and you know this to be true, right? So if this is you, and you want to buy stock, you go out into the market, and you give the market money, which usually is going through a brokerage, and the brokerage finds shares out in the market and gives you your shares. So the standard transaction for going long or being bullish is you give the market your money and the market gives you the shares. Well, shorting is exactly the opposite. So if you were short, this is you go out into the market, this is the market, and instead of giving the money, you sell shares. And the market gives you money. So when you short, you sell the shares and then you receive the money. So in this case, let's just give you an example. Let's say you sold $1,000 of a stock. Well, now you have $1,000 and you sold the stock. But of course, where'd you get the stock?
I think you have to borrow it.
Good question. So you have to borrow it, exactly. So there's usually a lender. And the lender is typically your brokerage, and the brokerage gives you the shares, and they collect a fee for loaning you the shares. Now, this can go on for some time. They don't necessarily have to close out their position at the end of the day or even at the end of the week or the end of the month, but eventually you have to close out the position because they've borrowed the stock from someone else, they've lent it to you, and you've gone out and sold it in the market. So the way you close out the position, I'll turn into red here, instead of selling shares in the market, you buy shares in the market. So the shares go to you, you give the shares back to the lender, and the lender gives them back to whoever they borrowed them from. And of course, to buy shares in the market, you have to give the market your money. So the way you make profit is the difference between what you sold them for and what you buy them back for. So if you sold them for $1,000 and you bought them back for $900, you made $100 profit. And of course, you've got to pay them a fee, so it's $100 minus the fee for lending you the stocks is your profit. So you can make money moving, the market moving up and a market moving down. And this used to be harder than it is because they used to have a rule called the Uptick Rule. And
well, what's the Uptick Rule?
Yeah, good question. So the Uptick Rule, some say the 1929 crash was, partly, or the Uptick Rule, or not having an Uptick Rule was partially responsible because if the stock price is going down and people want to short it, they can just keep shorting it and drive that price down very quickly. A lot of people say this happened to AIG, it happened to Bear Stearns, it happened to some of the other companies, that they were pushed down very quickly by a lot of short selling. And in fact, they had an Uptick Rule in the United States right up until July 2007.
Oh, interesting. What happened then?
Well, that was right before the big crash, right? So if you think nobody knew that there might be a market crash, well then why would they change the rules to allow all the short selling and piling on in a downturn right before we had a downturn? So
those short sellers were very happy then.
Yeah, they were very happy they could just jump on board on that. So, that was one of the things. Now, remember, what goes down has to come back up because converting your position or covering your position means you have to go back in the market and buy. And that can create a whole different scenario.
Maybe a short covering rally?
Exactly, a short covering rally. So what a short covering rally is if you have a lot of people that are bearish that have sold short the market, and all of a sudden the market turns around and goes against them, well, they have to cover their positions. And how do they cover their positions? By buying stock back. So if the market starts going up and you're short, you've got to buy back in, which exacerbates the rally upwards and can push prices up actually quite quickly.
And what's your takeaway?
So my takeaway is don't confuse different rules for an easier game. Investing all comes down to predicting the future. If you know what's going to happen, you can make a bundle no matter what happens. But since nobody really knows what's going to happen for sure or what's going to happen in the future, investing is risky no matter how you play the game.